The U.S. economy expanded at a slight or modest pace across most regions since early April. Consumers continue to push back against higher prices, the Fed said in its Beige Book survey of regional business contacts. While a weak Treasury auction saw higher, longer-term rates, although two-year rates fell marginally, this pressured equities, and we'll discuss that and discuss a couple upcoming single stock events today on Open Interest. Hello, everybody. I'm Mike Coe. Welcome to Open Mic. Price-conscious consumers will likely put pressure on profit margins, as we heard from Target last week when they announced broad price cuts to remain competitive. Fed Chair Jerome Powell and his colleagues continue to stress the need for more evidence that inflation is on a sustained path to their 2% goal before cutting the benchmark interest rate, which has been at a two-decade high since July. While most financial firms continue to predict at least some cut in short-term rates, SOFR futures options saw some bearish activity. There were a couple block trades in the SOFR March 94 spot 75, 94 spot 25, 93 spot 75 put fly. Goldman Sachs identified several stocks where they believe options are cheap going into earnings, including Carnival Cruise, Oracle, Federal Express, Jabil, formerly Jabil Circuit, and Hormel. So why don't we take a look at a couple of those, and we're going to start now, I think, with Carnival Cruise Lines. So Carnival Cruise, this is a stock that has recovered considerably from their pandemic lows when they were essentially shut down. The company is going to be reporting earnings on June 26th, so that's some time away still. Let's see what other events they've got going on the horizon. The thing is that during that period, they took on a considerable amount of debt. And I apologize because I had loaded up some charts earlier. So to those who are trying to show them, I apologize in advance if they are out of sequence with what I'm going to talk about. But Carnival Cruise was kind of the one that I was looking at first, in part because this is a business that, of course, it has recovered somewhat considerably off of the pandemic low. How could it not? And it's a difficult situation because the cruise lines, of course, have ongoing maintenance expense, so they have large capex that they essentially have to deal with, even when the ships are mothballed. Of course, as a result of all of this, the companies took on considerable debt. So to put things in perspective, Carnival Cruise had at the end of 2019 about $11.5 billion in debt, long-term debt. And it was probably about $11 billion in net debt when we look at it. Fast forward to the present day, and these numbers are quite a different picture. So to put things in perspective, the market cap of Carnival Cruise Lines is about $19 billion. So if you are looking at this company and you're thinking, oh, well, $19 billion and they've got maybe $22.5 billion in trailing 12-month revenues, maybe you're looking at that and thinking this is a 30% discount to where the stock was at the end of 2019. But when you factor the debt into the equation, it's a $48.8 billion enterprise value. And by the way, just for your back of the napkin work on something like this, when you're trying to think about what these businesses are worth, I like to look at enterprise value in most cases. There are some industries where obviously it's not all that appropriate. But if you subtract the enterprise value from the market capitalization, you essentially end up with the net cash position. And since this is $48.8 billion and the market cap is 19, so 19 minus 48.8, what you get to is a negative number. So if you have negative net cash, then what you actually have is net debt, and that is a fairly substantial amount. In fact, it's almost $30 billion of total net debt. And that needs to be supported by the trailing EBITDA is about $4.7 billion. So that's earnings before interest, taxes, depreciation, and amortization. A lot of people like to use that as a measure of a company's capability to meet its debt obligations. Of course, as I just pointed out, though, this is a business that has very real depreciation and amortization expense. So you shouldn't really use EBITDA because depreciation is a very real thing for ships. So we need to sort of factor that in. In fact, you should probably take a look at the company's capital expenditures on a run rate basis to sort of take a look at what, assuming that they're investing to offset real depreciation, that number is about $4.4 billion a year. So if you take a look at the forecast EBITDA of $5.6 billion and you take out CapEx, you end up with a number of about $1.6 billion or so in free cash flow. That's not a huge amount when you're talking about $30 billion in net debt. So I've discussed this on previous live streams, and I think this is also important. So if we take a look at what the implied move is, and again, we're looking out some period in time here, and the implied move is about 5.25%. And again, that's based on an estimate that's looking at the difference between options prices that happen to capture the event. An important point, though, and that is that you can't really compare that number to a really long-term history for the moves in Carnival Cruise on events like earnings, which happens to be about 5%, by the way. And the reason you can't do that is because the company has taken on so much additional debt. Therefore, the equity is considerably more levered now than it used to be. So consequently, the equity is going to be considerably more volatile. And I suspect that is one of the reasons why Goldman Sachs, in a recent note, said that they thought that the options here going into this event might be a little bit cheap. So my thinking, I'm inclined to agree. Why don't we just take a quick peek, and I'm just going to pull up on OptionPlay here, and we're just going to see essentially what these options cost. I'll just look out to, so the earnings are going to be in late June. So June options are not actually going to capture this event. So you'd actually have to look out to July. So we'll just take a look. I'll start by looking at the $15 straddle. So that's going to be the July 15 call and put combined, which costs just under $2, which may seem like a lot for a $15 stock. But again, bear in mind that this company actually, the debt exceeds the equity. So when you contemplate how much the stock could potentially move around, think about the volatility in that $50 billion enterprise value, right? So, and then translate that change in this context. So if you look at it this way, so we'll just round it up and call it $2. So $2 over 15, so that's 13.3% of the equity market capitalization, which I think we said was about 19 billion. All right, so that's so that implied move then is about $2.5 billion in terms of market capitalization, $2.5 billion over a $50 billion enterprise value. And actually what you're talking about is a change in the value of the business over the course of the next 51 days of, believe it or not, only 5%. So regardless of which way you're inclined to bet, it looks like being long options in Carnival Cruise is the way to do it. Okay, so the next question is, well, which way would we do it? If we are just taking a look at the OptionPlay application, we can see that the technical setup seems to be reasonably good. If you look up here, if you can make this out, I'm just going to highlight this area over here, but the 1 and 6 month trends are bullish. We can actually also take a look at other technical setups and studies and see whether those are similarly bullish. So just taking a look in the Bloomberg terminal now and choosing the most successful technical approaches to trading the stock over the course of the last year, we can see that every single one of them would be long here of all of the strategies that actually would have worked. Now, one of these isn't really a technical study. As you can see here, I'm highlighting this is buy and hold. So when it does this analysis, it always compares the technical studies to a simple buy and hold strategy. But all of these other ones are. Oh, actually, no, I'm sorry. I missed one. That's a mistake. The Rex oscillator is not long. Everything else would be. That is profitable. So you can see that there's some strategies down here that would not be long here, but those actually have not demonstrated profitability over the course of the last 12 months. So let's just take a look at the Rex oscillator and see where this one actually took its bearish position. That was relatively recent. We can see right here, the Rex oscillator, as you can see, is a very, very active strategy. A lot of transactions, a lot of trades. So it would have been 86 different trades over the course of the last year. If we take a look at some of these other strategies, which I think it's worthwhile to do, you'll find that some of these are not quite as active. I don't personally punt it around and sort of day trade, if you will, in that manner. So, we can take a look at some of these other ones that have significantly fewer transactions. So, for example, MACD approach would only have done about 10 trades over the course of the last year. It was actually the most profitable strategy, and you can see that it got long back here in late April, and the stock price was not considerably different than where it is right now. So if we just take a look at what street analysts think in this thing, we can see that in general, the view is a positive one. 21 buys, 3 holds, 2 sells. Average analyst price target is considerably higher than where the stock is now at about $21.50. Although it should be said that Morgan Stanley came out today. They actually have a considerably lower price target, $13.50. Remember, the stock closed $15.20 or so today. It's interesting. I don't typically make short bets or really big outright short bets. I had suggested, I think last week on CNBC, that if somebody was inclined to make a short bet on Dell, which is otherwise cheap, they could put on a no-cost 1x2 put spread going into earnings. And the reason I suggested a 1x2 put spread was because I would be willing to get long that stock at a lower level, and because I wasn't willing to outlay any kind of premium or take a bet that was going to lose if the stock should rally. Good thing too, because although I wasn't really going to talk a whole lot about Dell on this particular live stream, might as well, now that I've mentioned it, just point out that the stock has rallied considerably. Okay, yeah, and actually it was just pointed out. I'm just going to throw this up on the screen. So the 1x2 put spread, break even is 10%. Is there a similar structure where calls where you cap your loss or simply buy a put at 140 and adjust 1x2 strikes to pay for the 140 put? So very quickly, now I'm going to use the OptionPlay app to just illustrate a 1x2 put spread. The stock has obviously moved considerably since we talked about this a week ago. And it's probably not really important or relevant to talk about it in Dell at this point, although they are still due to report earnings, and the options market's implying a pretty big move, about over 10%, I think, for the earnings report itself, and over 11% by the end of the week. But let's just, well, actually, we are talking about Dell, so why not? I'll just keep it up here. So let's just take a look at what a 1x2 put spread looks like. As I discussed it when I talked about this last week, the objective here was to potentially make a bit of money if the stock had a bit of a pullback, knowing that it had this large implied move. but where I was still willing to get long the stock at lower levels, and where I was not willing to take a loss if the stock went sideways or higher. So the way you accomplish a trade like that is, you buy something that's close to an at-the-money put. So in this case, stock was 179. So let's just say I bought the 175 puts, and then you look to sell a lower strike put such that 2 times, such that you have no net outlay of premium. So now I did a very short dated one when I talked about this on the air. Oops, and I'm manipulating the wrong one here, excuse me. So we're going to go to the 160s now, and there you have it. Okay, so that trade is going to look a bit like this. Now, actually, this setup is assuming you wanted to carry a position as long as this, which the example I'm providing here goes out to July. If you were able to get a setup like this nearer term, this would be quite attractive because you actually earn a very modest, but you do get paid essentially on a standstill basis. So if the stock just sits right here, it would be profitable. It would be profitable anywhere to the upside. Peak profits would be if it runs down to the strike of the puts that were sold, which in this case are the 160s. The stock is 179 now. So that would be a decline of about 11%, which, if I remember, is approximately the decline that I was talking about when I was providing an example in Dell last week. Now, the issue I have with this particular trade example is that this one goes all the way out to July. And it's a very different thing to do a targeted trade like this with an identified catalyst in the near-term future using shorter dated options, because you basically know whether you won or lost quite soon. So I would prefer using a trade like this going into an event, but much more short dated. So, here I've got the June 7th, which is going to be the options that expire next week. Same strikes, effectively a very similar structure. Now you'll notice as I came back in to closer dated options, what you'll observe is that right around let's see here, where did this go from a credit? So it was, for July, it was a credit. As I move that expiration in somewhat, you'll observe that the premium becomes a net debit, although a very, very modest one. So, July 5th, paying 10 cents to put that on, 15 cents to play that out to the 4th week of June. And as we bring this into next week, 175, 160, actually going to be laying out $1.20. Not get a standstill rate of return if you play this out 1 week. But another way to think about this is that $1.20 on a $180 stock or thereabouts is not a huge amount of premium. And the other thing I would quickly point out too is that when the vol crush takes place, so after the event happens, as a percentage of their value, the further out of the money options are going to give up a little bit more of their premium. So if you just simply had a put spread on, that wouldn't necessarily help you, because even though the further out of the money put would see a larger impact from the vol crush as a percentage of its value, it's also a cheaper option. So the net effect would be that the higher strike option would have more of an impact from that vol crush. But when you do a 1x2, that's not necessarily so. So this trade, even though it does have a $1.20 outlay, it would not surprise me on a standstill basis to see this trade actually profitable by the day after tomorrow. So these guys are going to be reporting tomorrow. So just a potential trade to think about going into that. All right, so that brings up an interesting point, just going to Carnival Cruise, which is what we were talking about before. This is a trade structure you would not use in something like Carnival Cruise, because as we pointed out, here you're selling more options than you're buying. And if you think options are cheap, that's not what you want to do. You want to do the inverse of that. Or at the very least, you want to own more optionality, meaning that you would be long vertical spreads. If you're trying to offset, so if you're going to try to make a bet in Carnival Cruise and you wanted to spread it just because you didn't want to lay out that same amount of premium, you would still want to be in a debit spread situation, not net short options, because we think that options are, at the very least, fairly priced and arguably cheap in a name like Carnival Cruise. So just to modify the structure here, if you are going to, remember, they are going to be trading in June, so you'd actually have to go out to the July options. You want to trade a call spread. You might do something like this, buy the 15-18 call spread, actually getting a decent amount of premium relative to the 15s, 23 cents versus 117. And that, I point out that that's reasonable when you consider that these that are $1.17 are actually 23 cents in the money as of the closing price. So that's really, in terms of extrinsic premium, you're collecting 23 cents in extrinsic premium, and 117 minus 23, so you're paying 94 cents in extrinsic premium. And put those two things together, and it's 71 cents in extrinsic. But like I said, I think it's perfectly reasonable to simply play options on the long side for Carnival Cruise based on that balance sheet leverage dynamic that we were just talking about. Okay, so moving on, Oracle. Typically a late reporter in the season. They're going to be reporting in the second week of June on the 12th. Options market's implying about a 6% move. Long-term average is about 5.5%. Here's the thing, though. So why is that cheap then? Really what we need to think about is, and I'm not sure if we can put it onto, keep this chart up, and I just want to have you draw your eye to the following dates. So in March, on March 11th, the company reported earnings, and it moved almost 12% that day. If you go back to December 11th, company reported earnings, and the stock moved 12.5%. And if you go back to September 11th of last year, which is when they reported, the one-day earnings-related move was 13.5%. So where the very long-term average move is more modest, more recently we've seen substantially larger moves out of Oracle. And one of the reasons why I imagine Goldman is probably thinking that the options are reasonably priced going into the event. And based on recent events anyway, and I think those are probably a better example of what the stock is actually capable of, I would tend to agree. Now, one other quick point I would make is that the dynamic that we were talking about with Carnival Cruise, which was this this leverage, the balance sheet leverage dynamic, there is, unlike a lot of technology stocks, and I think a week or two ago we were talking about Zoom, which had reported on a Monday, and that's a company that actually has a huge amount of net cash on the balance sheet. But unlike a lot of other technology companies, the real powerhouses that don't really have net debt, Oracle does have net debt. Probably it looks right now like about $79 billion worth of net debt, so $420 billion. I mean, these are round numbers, and I think that should be good enough, especially since we were usually talking after the close anyway, so it's not going to be too precise based on tomorrow's prices. Things will change. Mileage will vary and all that kind of stuff. But yeah, this one does have a bit of balance sheet leverage to it. That said, fundamentally things look reasonably solid. We've got top line growth, at least historically, has been pretty good. Street's looking for year-on-year growth of about 6.6%. Folks who have paid attention to these live streams will know that one of the things I like to see is top-line growth that at least meets, but preferably beats, GDP growth, so broader economic growth. We would hope that whatever businesses we're looking at are going to have top-line growth that exceeds that of the economy. And here it does so. Not by a huge amount, but it is doing it. One other quick point I would make is that we should always be looking at these companies not just relative to the economy, because we're hoping that they would grow with the pace of economic growth, but also consider it relative to the S&P, because S&P growth exceeds the economy in general. That's what we would expect, because what you're talking about are the economy's winners. I've said this before. The S&P 500, the winners percolate to the top. And so the best managed businesses in the best space are going to grow orders of magnitude faster than the economy overall. And their respective weights within the S&P 500 grow as a function of that success. So if you go back over the course of the last 20 years or so, what you're going to find is that S&P 500 earnings growth is, close to 7% per annum, which is, round numbers again, because I think that's really all that's necessary for this part of the conversation. But that's double the rate of growth of the economy overall. So if you're going to try to pick individual stocks to play relative to the S&P, obviously you care about their multiple relative to the S&P, but our hope and expectation is that you're going to be picking stocks that are going to be growing at least as fast as the S&P generally. Doesn't always have to be the case if you're getting something cheap enough, but something worth thinking about there. Federal Express. So I apologize. I chuckle when I talk about Federal Express because this stock has just been the bane of my existence. I cannot tell you how many instances over the years, and it wasn't always simply because the company didn't perform well or something. I just also had bad luck. We had an auto hedger run amok a few years ago, and it was hedging a big call purchase that had happened street side. So I was making a market in some Federal Express calls. I think I sold 1,000 of them or something. This was not personally, of course. This was when I was making block markets. And an auto hedger ran out and bought a huge chunk of stock. It was a 6-figure hit within seconds. So I just have a bad taste in my mouth from Federal Express. It never seems to work out for yours truly. Hopefully everybody else has somewhat better success with it. But what I will say is that this is, it's a mature business. We wouldn't necessarily think so, but this thing can really move on earnings. And also, by the way, I think we held it in our 40 Act fund on the long side in late 2022. And if memory serves, that was a disastrous quarter for them. And actually, I'm just taking a quick peek here. Was it 2022? I'm pretty sure it was late. Yeah, so it's interesting. Oh, yeah, there it is. Okay, yeah. So if you see that late, we had the misfortune to own FedEx in our 40 Act fund in late 2022. Now, this is interesting because if you pull it up, some applications, actually, we can pull up my Bloomberg screen very quickly. And if you take a look at the historical, maybe we can blow this up a little bit so you can see it. I'm just going to highlight the quarter in question. So it's right over here where my cursor is. And if you take a look at this table, and depending on what sources you have for this data yourself, so they reported earnings officially on the 22nd of September, and the number was extremely disappointing. And if you take a look at the one-day price move, it's going to say only at 84 basis point, in this case a positive move. Now if we go back to that price chart, and you're going to see that big gap down, why is that? Well, this is usually the really the really bad thing that happens. And it's a pre-announcement, right? When the company announces the bad news ahead of time, and that's what actually happened. We got that news in FedEx not on the official earnings date. So by the time the official earnings date rolled around, by that time the cat was already out of the bag, and the damage was largely done. Now, I will also point out that that represented a phenomenal buying opportunity, as you can see here. So, sometimes, people just get a little bit too worked up about things. I'm going off of memory, and as you can see here, I mean, we're going back to September of 22. We're talking about well over a year and a half ago. So my memory is a little bit foggy, but I seem to remember that earnings, the price action that I'm talking about now, that gap lower that we experienced, was the worst in more than 30 years for Federal Express on an earnings event. So that obviously was a challenge. Now, as we look at it, one other quick point. Just things to think about. If there is some pressure on consumers, how's that going to impact Federal Express? So when we were looking at the results for Walmart and Amazon a couple weeks ago, Walmart's numbers were quite good. Remember, they reported the week prior to Target, and we saw 6% year-on-year growth. If you backed out inflation, it was 5.8, and if you backed out the extra selling day, it was something like 4.8. So quite solid. Amazon, I think, was seeing something like 12% growth year-on-year over the same period. I'm just talking about the retail sales side. Obviously, AWS Cloud Services doesn't have anything to do with Federal Express. So it would seem that, at least on a dollars basis, and in Walmart's case, we're just looking at what consumers are spending, and you back out that inflation factor, that there was some real growth. So if that persists, that can be decent, at least for a portion of their business. On the other hand, that's not the only thing they do. It's the only thing that we see from one day to the next. When we think about Federal Express, what we're usually thinking about is the deliveries to our doorstep. But we also are going to care a lot about what's going on the business side. And at least to hear business leaders discuss it, if you listen to what the Beige Book comments were based on surveys of business owners, that was a little bit less terrific, shall we say. But, looking at Amazon's number, it would seem like the e-commerce side still quite good. Okay. What else do we have here? I think we have... actually, this is a question... I don't know if this... so S-Browser Sync says, any theta decay. Is that question... So if you don't mind following up and just letting me know, are you asking that question with respect to the 1x2 put spread? That's what I'm assuming you're referring to. And the answer is not really. When you have a no net outlay of premium, it's going to be there's not going to be a lot of theta to it. It might actually, if you get it on for dead even or even a slight credit, there'd actually be a positive theta, a very modest one. But realistically, it's not a huge theta trade. And what's going to happen is most of what's going to happen to that trade is going to happen right after that event for two reasons. One, that's when the stock's going to move, and that's also when vol is going to move. So vol's going to come in and the stock's going to move. So if you think about it, that's when you're really going to figure out whether it's a win or a loss. Okay. Finn West asks, good morning, Mike. Just a reminder about my inquiry from last week regarding forecasting the expected move in a stock or an index. I believe you added some details not in your video reply. Thanks. Yes. So I did owe you guys that. So I wonder if I can, let me see here. I might be able, I'm going to, the producers can hear me, so maybe you guys can share. Am I able to put, a little Excel sheet into the chat that folks can access? No, I cannot do that. Okay, so I don't know if that's a security thing or anything like that, but apparently I cannot do that. Because what I was going to do was hopefully just drop an event variance calculator into the chat. So I think I'm being told we need to be on Discord. So I guess oh, don't be on Discord. I don't know what we're saying. I think it's a bit of a joke. I think the idea is that we need to find a better way where we can transfer information like Excel files and stuff like that. But let me see if I can get that for you. Okay. Yeah. So I promise to try to figure that out. What I'm probably going to have to do is there's a couple steps to follow to figure that out, and just a couple things you're going to need to know. But what I want to do is give you guys the tools so that you can figure this out. I don't want to do the calculation on it like a case-by-case basis. That's not really helpful. What would be helpful is for you guys to know, how the formula works yourself and give you something that doesn't require a data feed. So you can just plug the numbers in. Here are the things you'll need to know. You will need to know some basic information like the implied volatility of some options that you select. So, you can probably just get that from almost any online source. You can probably get it from Yahoo Finance. You need to identify how much time there is to expiration for the 2 expirations you're going to use when you calculate this, which is easy enough, right? So, you'll know the expiration date for the respective options. You need to know the price of the stock. And with those things, you'll be able to calculate event variance. One quick point I would make that this will work for stocks where there is some event variance baked into options prices. And what I mean by that is if you're looking at an event, the nearer dated option is going to need to have a higher implied volatility than the subsequent options that you were looking at. So you need to have some backwardation in the term structure. The nearer dated options are going to have to be a little bit higher because the math won't work otherwise. But I will put that in. It's not hugely complicated, but I will definitely do that. Okay, NVIDIA. I rolled up NVIDIA in the money calls 3 times already since their report. Now I have June 1260s, 1290, and 1300 long calls. Let it ride through post-split or close or reduce to buy the SEPT out of the money options. Okay, well, a couple quick things about this. First of all, what's happening in NVIDIA at this moment is really, well, first of all, if you had calls going into the print, good on you. This is really a momentum trade here. So while it's my preference generally to like to own subsequent events, which would push you out to those September options, I don't think there's a whole lot of harm in just sort of continuing to own the momentum here. So a quick point about the stock split. So the company's got an upcoming stock split, and you guys have not asked, but some do from time to time. What happens to options when you get a stock split? So you are going to end up with, if you have a 10-for-1 stock split, we're talking about here, you're going to end up with options on 10 times the number of shares and 1/10 the strike. So, for example, your 1260s are going to be 126 calls, and the 129s will be 129s, and the 1300s will be 130 calls. If you owned one of each of those, you're going to own 10 of each of those afterwards. And then the premium will also be approximately divided by 10. So there's no negative impact waiting for that split to take place. There's actually only really a positive impact because you'll have more flexibility with respect to sizing. So, like I said, if you've got one of each of those, you'll be able to pair your position but maintain those exact same strikes. That's, I think, an easier way to do it. And actually, now that I think about it, you're specifically saying June. So the question we have to ask ourselves is whether or not, so what is, now I should know this off the top of my head, but I don't actually. So when is that split supposed to be effective? So I'm going to just go, it's probably on the OCC site. Let's see. So this is actually helpful. If none of you ever have done this, the Options Clearing Corporation website is a tremendous resource. I'm going to actually drag this onto one of these. June 7th. Okay, so that's what I'm hearing. What? The 10th? June 10th. Okay, so June 10th is when the split becomes effective. And let's see. So let's see, Options Clearing Corp. So this is a great website for. So you can go to this info memos section on the OCC website, and it'll tell you anything that they've published. So we can actually put NVIDIA in here, and you can see it popped right to the top here, right? So they posted it on the 23rd of May, and you can see the effective date right here, June 10th. And then you can just click on this. You'll bring up a PDF, and it'll basically describe what's going on. So NVIDIA Corporation has announced a 10-for-1 stock split. The ex-distribution date is June 10th. So if you buy the stock on the 9th, actually, what day of the week is the 9th? Let's see, let's take a look here. So the 9th, yeah, so it's going to be, the 9th is actually a Sunday. So the effective date is the 10th, so the last date to do it is going to be the 7th. So that's the last trading day prior. So yeah, this is a great resource. I highly recommend that if you ever have any questions about what's going on, about the impact on options, usually we're talking about really straightforward stuff, not too complicated, so you don't need to look up info memos for that. But sometimes you will get situations where it's really helpful. This is a resource I rely on whenever I have a question about anything like that. So I hope that's helpful. So that's the OCC.com. And then you go to the info memo section, and you can search, some cases you might know what the info memo is. In other cases, you can just search by ticker or by the corporation name, and you'll get information that way. It's very helpful. By the way, while I remember, I did point out that I'm going to be traveling for. So I understand that we're having a little bit of a technical issue with the live stream, with the broadcast. So I want to just point this out because we may have some future issues with these live streams, and I think I'll bring this up right now. I am going to be traveling, as my family usually does, to the East Coast. So as soon as school gets out for the kids, we typically go to the East Coast for a couple of weeks. I am going to be traveling even more extensively, so I'm going to continue to try to do the live streams, but I'm going to be doing it from the road as part of the traveling, and I'm going to be doing it remotely from the beach in Massachusetts and also in New Hampshire. So we have good connectivity there, but a lot of the resources that I have here that make all of this possible, we're going to try to set up a kind of a portable kit for that. So I apologize in advance if over the coming week. So I expect to remain in California next week, but at the end of next week is probably when I'm going to be leaving, and then I'll be doing all of this stuff remotely for several weeks thereafter. So yeah, let's see. Do we have any other questions? Okay, so oh yes, I guess this is about the same thing, and trying to tell you guys how to think about it. Like I said, I was saying how to think about it, but I've got to figure out a simple way to get that information to you so that it is digestible, and a thank you here, which of course I also really appreciate. So given the fact that we're having a little bit of technical difficulties, and I think there's a bit of stutter introduced, I think we'll cut it short here, and I'm also going to do that because I'm going to be appearing on Fast Money shortly. But tune in next week on Monday at 4:15 for the next open mic live stream, and thank you all for watching.